Silicon, are we reliving a $1 trillion bubble or building the next century? Picture America in the 1840s. Fewer than 3,000 miles of track lace a young nation. By 1900, that lattice explodes to nearly 200,000 miles. That's not growth, that's an economic Big Bang. Towns become cities. Prices fall. Time compresses. A coast-to-coast trip that once took months shrinks to days. Now fast forward. Today's chugging locomotive is a GPU, the glowing coal is data. We're laying down not rails, but model weights and fiber routes. And the money? In both eras, it floods in like a spring river after a hard winter. The question isn't whether we're seeing a boom. The question is this a bubble we'll regret, or an infrastructure we'll bless for a century? In the 19th century, the United States lived through a transformation. Around 1840, there were roughly 3,000 miles of railway. By 1870, that figure had reached about 50,000 miles, and by 1900, nearly 200,000. After the Civil War, thousands of miles of track were added every year. Railroads became the largest non-farm employers and the biggest consumers of capital in the nation. In Britain's railway mania of the 1840s, annual rail spending reached almost 7% of national income, a level of infrastructure investment we now associate only with war or green revolutions. Investors adored the story. Rail equities dominated the exchanges. Ordinary families bought shares and bonds. Expansion seemed inevitable. More rails meant more freight and more profits. But reality intruded. In 1873, a leading underwriter of Western rail projects failed. Contagion swept the markets. Dozens of railroads defaulted, and the U.S. entered what historians call the Long Depression. 20 years later, in 1893, another credit crunch hit. Over 150 rail companies went into receivership. Between a quarter and a third of the entire U.S. network passed through bankruptcy. Yet the infrastructure endured. The weak disappeared, the strong consolidated. 5 great transcontinental lines stitched the country together. Freight rates fell, productivity soared, and the American economy entered its first age of scale. The investors who chose wrongly lost everything. Those who picked the survivors, or the steel mills and bridge builders behind them, captured generational wealth. Today, we are watching a similar drama unfold around artificial intelligence. The new rails are compute capacity. The locomotives are foundation models. The depots are data centers. Global AI investment, corporate, venture, and M&A has climbed into the hundreds of billions of dollars. Analysts project $1 trillion in cumulative AI and AI infrastructure spending by the end of the decade. Training frontier models already costs tens of millions per run, and inference spending, serving live queries, is growing even faster. Hyperscalers are devoting tens of billions each year to new campuses, high-density racks, and long-term power contracts. Semiconductors are the choke point. Demand for AI accelerators exploded so violently that the leading chip makers' valuation passed $1 trillion on the logic that, in this gold rush, the suppliers of picks and shovels win first. The geography of AI resembles the old map of railroad hubs: Northern Virginia, Dallas, Dublin, Frankfurt, Singapore, Tokyo. Availability of power and cooling now determines which cities become the new junctions of the digital world. Unlike the scattered entrepreneurs of the railroad age, today's race involves titans. Google, Microsoft, Meta, Amazon, Baidu, and Tencent are the Vanderbilts and Goulds of our era, pouring billions into chips, data centers, and models. Startups, too, are raising unprecedented sums. OpenAI valued at around $157 billion, Anthropic at over $20 billion, xAI approaching $50 billion before releasing a product. These numbers echo the euphoria of the 1880s when investors funded parallel lines across empty prairie. The same mathematics drives every boom. Capital expenditure races ahead of realized revenue. Railways needed passengers and freight. AI needs monetization. Productivity gains, co-pilots that cut coding time by half, algorithms that shorten drug discovery cycles, customer service tools that reduce call volume by double digits, must materialize fast enough to justify the spend. Utilization is everything. A 19th century line with too few trains bled cash, a 21st century cluster with idle GPUs does the same. The best operators aim for sustained utilization above 70%, squeezing value from every watt and chip. Network effects fuel both curves. More rails brought more towns and more freight, lowering costs and inviting yet more rails. More AI users create more interactions and data, improving models and attracting still more users. Scale begets advantage, but only a handful of players can sustain it. If a correction comes, it will rhyme with the old story. Startups with high burn and weak distribution will vanish or be absorbed. Hardware cycles will swing. Second-tier demand will soften. Inference pricing will reset, and regulations on data provenance and model safety will raise fixed costs, favoring incumbents. Yet the physical and digital infrastructure, the fiber, the servers, the power links, will persist and continue generating returns. The investor's playbook remains timeless. Own the picks and shovels, but remember they are cyclical. Bet on platforms that turn compute into sticky workflows with short time to value and retention above 120%. Treat power as the new land grant. Cheap, reliable electricity is the scarce resource of this century. Regulation, too, can entrench winners, just as the Interstate Commerce Commission once legitimized the giants. Diversify because survivorship bias hides the wreckage. And price optionality, not fairy tales. Plot the curves side by side. U.S. rail mileage from 1840 to 1900, global AI compute from 2010 to today. Both surge upward with uncanny symmetry. The 19th century mania nearly destroyed the system that ultimately made us richer. The 21st century mania could do the same, or it could build the backbone of a new economy. The choice lies in how we invest, manage, and endure the cycle. The economy we want in 2030 and 2040, more productive, inventive, abundant, requires overbuilding in 2025. That's how infrastructure gets laid. The art is not to avoid the boom, but to survive it, and to own what still matters when the noise fades. Steam built the 19th century. Silicon is building the 21st. Don't mistake the shakeout for the story.